Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So these are the benefits if they allow their currency to float, and it's something that I talked about when I was there in China at the time, but it didn't really matter. It's a pressure valve, really, for their FX reserves and the massive flows that are they get stuck in there. It blunts their import cost. A rising currency does two things for them. One, their massive need for commodities goes down if their currency value goes up, and it also enhances the purchasing power of their local consumers. So it goes hand in hand with developing a more vibrant consumer market, and increasing the value of their currency makes sense at this point in time. Local producers really, in terms of a more vibrant, again, think of the hand-in-hand process of developing the consumer market and letting their currency increase at the same time. Then their local producers no longer are so highly dependent on export. They have the advantages, to turn internally. All those forced savings all of a sudden come out and into the local producers' pockets. So it's a more natural process. From a global trade standpoint, if the Chinese consumer can start buying goods from the outside, taking off capital controls, part and parcel to the currency value being lifted, you're going to see trade start to flow both ways. Actually, it would be, most people say there's no way, but the Chinese consumer can't buy the stuff now. It's really that basic. If you have 2 billion people and their purchasing power is increasing and they unlock those savings, you can bet they'll start buying more Western goods. So you'll see that two-way street, and that process in and of itself would be very, very good in terms of this whole idea of continuing global rebalancing and reducing volatility in terms of these massive imbalances that have grown out of this Chinese fixed exchange rate policy. No longer need to hold U.S. paper. That's really the key. How does that play out? Doesn't necessarily mean it's a disaster for the U.S., but if U.S. fiscal situation continues as it is, which I doubt we could continue to spend as much money as we have, but if it does, it's a real problem because the U.S. is going to would lose a funding source. But we think that process, which leads to rebalancing trade, then the U.S. that whole big negative need, or that need for U.S. external funding goes away if you have more balanced trade. Once the U.S. becomes more of a producer, again, this is kind of a pipe dream, and I know it sounds crazy, but if it happens, then the U.S. doesn't need all that external funding. So if China doesn't fund them, and the need for funding goes away from the U.S. because of more balanced trade, it's not as a disaster scenario as people play it out to be. Here's the block implication in terms of the currencies we think, what Steve and I were discussing earlier. Right now, breaking the currency blocks into three areas. You could possibly make some others, but these are the three we look at. And again, think of these as global macros, squeezing these different, say they're different tubes of toothpaste here. The savings block is the Euro countries, the old line countries with older demographics, big savings, very overvalued at the moment. The euro and everything else, pound, Swiss, those very overvalued. The pound is starting to come back, but still overvalued in terms of the world, in terms of their growth opportunities. Commodity currencies probably fairly valued, would probably become overvalued. If China gets through this process and continues to grow, they would take over that overvaluation. And you have the extreme undervaluation of the Asian bloc currencies, which are the trading currencies that have relied on this export model. One of the reasons the Asian bloc is precisely because China has pegged its currency. They have to compete against China, so they've done everything they can implicitly to try and keep their currencies under wraps. So as China starts to let its currency increase in value more and more, the undervaluation is not as necessary for these Asian bloc currencies. And they, too, in tandem, will follow this process of building bigger and more vibrant domestic markets to a lesser degree than China. So again, their need to suppress their currencies will go away. Already on a purchasing power basis, the Asian bloc currencies are massively undervalued compared to the Euro bloc areas. We see differences of 100% when you think of you see some undervaluations against the dollar 40-50% in the Asian bloc, and you see some overvaluations against the dollar in some of the European currencies, 40-50%. That difference between the Asian area and the Euro area, the undervaluation versus the overvaluation block of currencies is massive, and to us that's the game. Ultimately, on a low leverage basis, is to stay with these trades. Our favorite trade in the world right now is short the euro and long the Singapore dollar, and we think this valuation will continue to be squeezed and squeezed and squeezed out. Same thing with the Thai baht. So every access we can to Asian currencies, we're trying to pair them against the European currencies. The other play, of course, would be pairing the Aussie and Canadian dollar against the European bloc currencies. Canadian dollar, Australian dollar paired against the pound long term. Trades like that you can effectively do using the FX options product on the ISE. You can create a simulated pair cross like that, and Steve can talk to how to do that. Question is, if they change the peg in here, if they make a small adjustment here, we don't think much is going to change, but we do think it's potentially beneficial in terms of taking some pressure off China from a trade standpoint. So just even some window dressing there will help, and it will also show that China understands the problem here in terms of their currency and is starting to make a move. Ultimately, China wants to have hegemony over the U.S. and wants their currency to be the world currency, if that's what we do. It may be, like I said, 10, 15, 20 years away, but ultimately that's what they want to do. But they're going about this, again, very gingerly here, given what's going on in the world. If they were to float their currency, it would be pretty shocking in here. I just don't think we're going to see it. But if they did, it changes the equation dramatically in terms of what they may do in terms of U.S. paper. But until, and this is really the key and why we haven't seen the disaster scenario that a lot of the newsletter writers talk about, they're not going to dump the U.S. Treasury bonds until they have another source of demand. And that demand has to come from them, their own markets. So that's the balancing act, and that's why you hear this idea of the symbiotic relationship staying intact. Once they develop their own domestic market, then it changes. It changes in a big way the demand or their need to hold U.S. Treasury paper. But once they have a domestic market, again, you're going to have more balanced trade, so the need for external funding for the U.S. Should decline, and I say should because given our fiscal situation, there's all bets are off. But that is the process that doesn't lead to the disaster scenario that you hear a lot of people talk about. Keep in mind, when you push on one side of one side in global macro, there's another reaction on the other side. What happens is when these people write about this stuff, they tend to take things as they were, look for a change, and don't look for the potentially beneficial change on the other side, which would be more balanced trade and the U.S. having a lower need for capital. So keep that in mind when you hear the scare scenarios on China dumping the bonds.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.